Imagine a company that has increased its profits for 15 years in a row. A company that pays a dividend that gets bigger every single year. And yet, 90% of investors don't even know about it. That company is Visa. Think about it. Every time you swipe your card, whether it's for coffee or a new car, Visa takes a tiny slice. They don't lend money, so they don't take on lending risk. They simply act as the bridge connecting buyers and sellers all over the world. Their business model is genius in its simplicity. There are over 3 billion Visa cards in circulation globally, processing 200 billion transactions a year. Visa takes a minuscule fee from each one. It's like owning a toll booth on the highway of the global economy. So, why does this work so well? Because cash is on its way out. Every year, more and more of our spending becomes digital. And as that trend continues, Visa just keeps making more money. They don't have to invent a new product. The global shift towards digital payments does all the heavy lifting for them. Let's look at the numbers. Visa's revenue grows at about 10% every year, but the truly staggering number is their profit margin, 50%. That means for every single dollar they make in revenue, 50 cents is pure profit. Most companies would be thrilled with a 20% margin. This is why many consider Visa a financial fortress. Could you compete with Visa? Well, you'd need billions of dollars to build the infrastructure. You'd have to forge partnerships with every major bank on the planet, and you'd need to earn the trust of billions of consumers. So, good luck with that. This massive barrier to entry is what investors call a moat. And what about the dividend? Since going public, Visa has increased its dividend every single year. They did it through the 2008 financial crisis. They did it through the pandemic. That level of consistency is what long-term investors dream about. Of course, no investment is without risk. The first major risk is regulation. Governments can get nervous when a company has this much power. They could step in and limit the fees, Visa charges, or try to force more competition. The second risk is, well, competition. MasterCard runs a very similar playbook, and new players like PayPal, Apple Pay, and even cryptocurrencies want a piece of the action. That toll booth is getting crowded. Right now, Visa is trading at around 30 times its earnings. Is that expensive? It depends on your perspective. If you believe their growth will continue at this pace, it might be a reasonable price to pay. But if that growth slows down, you could be overpaying. Here's the trend that really matters. In 2020, about 30% of global transactions were digital. By 2026, that's projected to be over 50%. What about 2030? 70%? 80%? No matter how you slice it, Visa is positioned to win. So, the real question isn't whether Visa is a good company. It's a great company. The question is it a good investment at today's price? Smart investors don't just buy a great company at any price. They are patient. They watch the market. And when fear causes the price to drop, that's when they make their move. Great companies don't always make great investments. Price matters. Timing matters. I'm not here to tell you what to buy. I'm here to teach you how to think like an investor. If you want more analysis that actually makes sense, make sure to follow along. Thanks for watching.